The 30-year residential rental loan, also known as DSCR financing, has been a great opportunity for private mortgage lenders to fund more loans over the past 2 years, and the volume has been explosive in 2021 as the appetite for these loans from institutional capital has increased and the Fed funds rate has fallen to record lows. Many private lending companies originating these loans have to debate whether they want to fund these loans from their balance sheet and then sell to the secondary market, or partner with a capital provider that offers a wholesale program to fund the loans. While attending the IMN Single Family Rental Conference in December 2021, I interviewed Alex Offutt from Constructive Loans and asked him to make the argument for choosing a wholesale partnership. Constructive is one of the largest private lending companies in the country for funding and servicing long-term rental loans. I'm Butani, CEO of PrivateLenderLink.com, where investors and brokers can easily find direct, private, and hard money lending companies. If you're in the investment real estate business and want to gain insights into private mortgage lending, subscribe to our channel and get notified every time we release a new video. So Alex, a lot of lenders in the private lending industry ask me about whether I know any buyers for 30-year rental loans. So they want to fund these loans off their balance sheet and then sell them, and they're asking me for who buys them. But I've always told people, why do you need to fund them off your balance sheet? There's companies like Constructive that can just fund it for you. You don't have to have your balance sheet to fund them. What do you say to those people as far as what's the benefit of using a wholesale program versus funding and then selling?
No, it's a great question. We at Constructive, we built out a wholesale-based model. The idea behind it was there was a gap in the marketplace, and I'll explain really briefly. Not everybody has the capacity or the desire to fund loans and close them on their balance sheet. There are obviously additional overhead expenses, not to mention the balance sheet risk of having to own a 30-year loan on your using your capital. And then obviously the risk of whether or not you can sell it. Now obviously that risk is somewhat minimal, but I think we saw during the COVID interregnum, if you will, back in early parts of 2020, where a lot of lenders were actually unfortunately stuck with a large number of these loans that they couldn't sell. With our wholesale model, the goal has always been, like you asked in your question very succinctly, why do I need to close it and fund it if I can just have somebody else fund it for me and I don't have to take on the additional overhead or risks in order to do so? And that's kind of been our guiding principle. Mm-hmm. We work with lenders and brokers that send us as few as 1 to 2 loans a month to some that send us 60 to 70 loans a month, right? The idea is that we want to be able to provide this measure of capital to individuals that may not otherwise want to close a loan and then have to sell it after the fact.
But for everyone, it comes down to pricing and profit, right? So they can always use someone else's capital, but then they're concerned that, is that capital provider going to charge any points? I can't sell that to my borrower. And then can they actually make a profit or more of a profit from funding it and then selling it versus using a wholesale program?
Look, candidly speaking, when you go to sell a closed loan, you're generally going to get slightly better execution than you would with a wholesale model. However, that comes with a number of caveats. In order to close your own loan, you have to employ additional operational resources, processors, underwriters, closers. Mm-hmm. Obviously, there are post-closing requirements, not to mention the additional cost for like loan docs and other factors that can take that perceived profit and erode it. When you start to actually look at the actual cost of originating that loan, we take all those costs on ourselves. Now, yes, we have a small per loan fee that we charge. We don't charge any points to our borrowers. And we still give our clients the opportunity to earn yield spread, which would be the same equivalent of trying to sell a loan for above face value.
Okay, interesting. So that makes sense because there's a lot of lenders out there that have short-term loans that they fund that may not require these additional resources and additional docs and all the other requirements that come along with selling the 30-year rental loans. So why would they set up that kind of operation and take on all those costs just for a portion of their business?
Well, right? The biggest difference between short-term, let's just refer to them as short-term, bridge loans, and 30-year is, 30-year loans almost always end up in a securitization of some sort.
Sure.
And the people who are buying these loans out of the securitizations are used to buying loans from, that are Fannie Mae, Freddie Mac, Ginnie Mae loans. Every I is dotted, every T is crossed. There's no flexing here, there's no flexing there. Either you have it or you don't, from a, documentation, credit perspective. So obviously, a 30-year loan is just by its inherent nature more complex, and, more laborious than, what a regular bridge loan would be. So again, you're asking, somebody that potentially is a good bridge lender that is able to make a good informed decision because they know their market, their region better than anyone. You're now asking them to basically play by what I would call almost like a different set of rules that they may not be familiar with. Our goal has been to take that concern away from those lenders and put them in a situation where we're better able to, help them, grow this product without it putting undue stress on their resources or, their balance sheet.
Okay. Some private lending companies will always opt to fund loans using their balance sheet, even if it requires additional costs and resources. And I know many lenders that have zero interest in originating DSCR rental loans because it's so different from short-term lending, and they don't want to deal with institutional capital providers. However, a wholesale partnership could be a great way to earn additional revenue while these loans are in high demand. If you're ready to explore wholesale partnerships, use our website privatelenderlink.com as a resource to find capital providers. From the main menu, click Services to access our service provider directory. Then click Capital. Browse the main list or select one of the categories in the filter section. Click on each company's profile to learn about their program, then click the green contact button to find their phone number, an email form, and a link to their website. When you reach out to capital providers, please remind each company that you found them on privatelenderlink.com. If you don't find what you're looking for or would like more capital options, reach out to us for assistance. We have relationships with many companies that provide capital for private mortgage lending. If you found the content in this video to be useful, please click the like button and be sure to check out our other videos about private and hard money lending. Thank you for watching, and see you in the next video.